There's a lot of nuance when it comes to how individuals are taxed. Individual can have a long-term or a short-term cap gain. They can have salary or wages, which is always through a W-2. If you ever hear the term 1099 employee or 1099 salary, that's like saying dry water. It doesn't exist. I invite everyone to remove those words from your vocabulary because they are confusing. And this stuff is confusing enough as it is. When we're talking about ordinary income under an LLC, most LLCs are what we call pass-throughs. When you hear the word pass-through, a pass-through entity is something that passes through its income or its expenses to its owner or to its shareholder. And that means the LLC itself isn't getting taxed on the corporate level, at least not from a federal standpoint. There's nuance when it comes to the states. We're not even going to get into that here. We're going to focus on federal for right now. But if these are passing through to you, then the LLC could be doing short-term cap gains trades and passing through to you as if they were yours. Well, when you make this election, those short-term gains go from being cap gains to being ordinary business income and losses. Now, why would you want to do that? Well, for one thing, you're no longer going to have to deal with the wash sale rule. The wash sale rule specifically is designed to apply to traders, particularly day and swing traders, because it's a 30-day rule. So this can affect a swing trader as well. Even if you're not day trading, if you're in and out within a couple of days or a couple of weeks, you're still within that 30-day mark. And so you run the risk of, if you have a couple of positions that fail, you might lose money. But even though you lost that money, you're not allowed to deduct it. That's what the wash sale rule does. It's nonsense. I'm of the opinion that only exists to mess with traders. Like, it doesn't really... They'll say that it's there to stop you from creating artificial losses. Well, you either lost money or you gained money. If you lost money, then you lost money. Right. So now we get to turn around and we get to treat our trading activities as if they were ordinary business income and losses. Well, we no longer have to deal with the wash sale rule. You're now claiming the income under the business like it was any other business operation. Real life trading provides educational services. Some of them are free, some of them are paid. The paid ones, that is ordinary gross income that comes into RLT. RLT deducts its expenses against the ordinary income, and the difference between those two things, that is your taxable gain or loss. That's how a normal business would work. So now we take our trades and we take them out of that realm of short-term cap gains and into the realm of ordinary business income and loss. We got around that wash sale rule. We've also opened the door for regular business deductions, and we'll do a separate video on that. But we've opened the door for regular deductions. We now have a place to report them, and if you're making a legitimate business out of trading, you will have legitimate business expenses, and I'll tell you what those are in a different video. But you're also opening the door for your LLC to make other elections. So you're going to hear me use the word election a lot. An election is exactly what it sounds like. An election is, we're going to file some forms to the IRS and say, IRS, we want to be taxed like this. We want our trades to be treated as ordinary business income and loss. We don't want them to be treated as short-term cap gains anymore. There are rules for businesses that say, well, you could report your income this way by default, or you can make an election to have it be reported differently. So we could make an S election on our LLC. And now our trading operation, which is a business now, is going to be taxed under S Corp rules. I think one of the drawbacks of converting short-term cap gain to ordinary is you run the risk of exposing yourself to what is broadly called FICA tax. A lot of people are going to know it more as self-employment tax, or they're going to know it more as Social Security and Medicare tax. That's the most direct way of describing it. It's all the same nonsense. The income tax, the federal income tax, was actually brought into existence by a constitutional amendment. You'll see kids online arguing over whether or not it's constitutional. Well, we amended our Constitution to allow Congress to impose an income tax. Social Security and Medicare is a whole other story, and I won't get into that too much in this clip. If you're self-employed, if you have a W-2 job, you're being exposed to these FICA taxes, which stack together with your ordinary income tax. So you got your ordinary income tax, but then we have to add on this FICA tax. The S Corp is a method by which you can mitigate that FICA tax. So one of the potential drawbacks of 475 is, okay, we're going to expose ourselves to this FICA tax, but we have ways to kind of work around and mitigate that, and that's going to be another video we're going to do here. So we're going to talk about how we're going to do that. But to summarize, if you were to open brokerage accounts under an LLC and you meet the right qualifiers, you might qualify to use Section 475, mark-to-market election. Now your short-term cap gains are going to be treated as ordinary business income and losses. You have effectively avoided the implication of the wash sale rule because you're no longer short-term cap gains. You are now ordinary business income and losses. You've opened the door to make other elections on the LLC to affect how it's going to report those ordinary income and losses. And how you report them is going to affect how they get taxed. And you've opened the door for just regular run-of-the-mill business deductions. And we'll talk about that in a future video as well. So let's hit on a very misunderstood concept, because there's all these buzzwords that get thrown around in my industry, especially on social media, usually by people who don't do this type of work, which is the best part. One of the most common buzzwords is S Corp. S Corps are the most one-trick pony, misused, mishandled option in the entire tax strategy world. Like, most of the S Corps I look at aren't even really legally set up. And the way, I'll tell you specifically why they're not legally set up. So if you make an S election, so an election is just you hand a paper to the IRS or you mail it to them or you fax to them, and it says, hey, IRS, we want to be treated like this for taxes. This is how we want you to tax us. And the IRS will reply to you. They'll send you a letter back saying, we got your election. You are now taxed like this, Craig. By the way, here's all the things you have to comply with. And so when you make an S election, they actually send you a letter that says, you must comply with Revenue Ruling 7444. That's the technical term. And what all that really means is you have to take a salary from your company. Now, remember what I said earlier. There's no such thing as a 1099 salary. It doesn't exist. That is categorically incorrect. So what they mean is they want you to take a salary from your company through payroll like an employee, exactly like an employee. So when I talk about S Corps not being legally set up, it's one of three scenarios. One is they have an S Corp set up and they have no salary whatsoever. Huge no-no, don't ever do that. You're literally, remember that letter they sent you? Hey, you have to take a salary. They literally spelled it out for you in writing. So if you're not doing it, you're just straight up ignoring what the IRS told you had to do. Not a good idea. Scenario number two is they take like an insultingly low salary. They'll take like $1 a month. I've seen that. Like $1,000 a month. I've seen that more commonly. And these just aren't going to hold up. So something that you want to always bear in mind with tax, this is one of the key things I tell people this and they gasp. I'll go to a mastermind full of business owners that are used to making more money, and I'll tell them this, and they're like, really? Who has the burden of proof in court, Craig?
That would be the defendant.
The defendant?
Well, I'm going to feel like they want to prove that they didn't do it.
Well, so in criminal court, this is what we're taught in school, right? You know, you're innocent until you're proven guilty. That's what we're taught about our court system in school. But that's specifically in the context of criminal court. That's not tax court. Tax court is the exact opposite. If the IRS makes an assessment, so we'll use the reasonable salary as the example. They say, Craig, your $1,000 a month salary is too low. You're worth more than that. You have to prove them wrong, or they are right by default. Even if you take it to tax court, if you cannot make the case that your $12,000 a year salary is reasonable, you automatically lose. They are automatically correct. They might look at you and say, Craig, we think you're worth $150,000 a year. Prove us wrong. If they say that and you can't prove them wrong, well, now your salary just got adjusted from $12,000 a year to $150,000 a year. That's a lot of FICA tax. When people get into business for the first time, when they're doing their first self-employed gig and they get their first tax bill and it's insanely high, it's not because of ordinary income tax. It's because of self-employment tax. Most returns we do that have a net income under $50,000 under a sole prop, 80% of the tax, give or take, is coming from that self-employment tax. So self-employment tax is no joke, and the salary you take from your S Corp is not a joke either. What we do in-house is we have a SAS that we use, and we create this detailed report of the client. What are they doing on a day-to-day basis? How long are they doing it? How proficient are they? We have ways of stress testing your proficiency, stress testing the salary. And then you actually have this long report that directly cites IRS guidelines of what a salary should be, saying this is reasonable based on these guidelines. Is it bulletproof? No. Nothing's ever bulletproof, ever. Anyone who tells you that their strategy is bulletproof, again, it's like someone who claims to know everything. They don't. But are you on a much stronger position now? It's not even close. Someone just makes up a random number versus having a detailed analysis. Someone's taking a flat number versus taking a very specific number that's based on what they're doing on a day-to-day basis. What is the market value of what you're doing in the business? There's no comparison there. One is a much stronger position, and you can actually tax plan around that. Because here's the other thing about these S Corps. You don't know if an S corporation is an effective tax classification for you unless you know what your reasonable salary is going to be. If your salary is too high or too low in some cases, the efficiency of that S Corp drops off pretty hard. I can't tell you how many people I've worked with who had an existing S Corp. It was losing the money. Not only was it losing the money on the tax front, but S Corps have maintenance. S Corps file a completely separate return every year. So right off the bat, you have the expense of running payroll, the expense of filing an additional return. And then the S Corp has to be able to save you enough money to mitigate those extra costs and have you walk out with more money in your pocket at the end. That doesn't always happen. Again, especially when it's a blind S Corp. If it's blindly set up with no reasonable comp analysis, then more often than not, I see, again, just a lot of cases in practice, in real life. You know, the theme of this is real life trading, real life taxes. In real life taxes and real life scenarios, I see just as many S Corps screw their owners over as I see it actually benefit them. And the ones who are getting benefits, all it would take is the wrong IRS agent to go in there and audit it and mess with their reasonable comp to blow up their benefits. Now, all the benefits you enjoyed for the last couple of years, you get to pay those back with interest. That is not a position you want to be sitting in. And S Corps, you know, I just got done saying they're used, they're abused, they're the biggest one-trick pony on the planet for my industry. C Corp's the exact opposite. CPAs hate them. If we went out here in South Florida, found 10 random CPAs and asked them what they thought of a C Corp, 9 out of 10 of them are going to say it gets double taxed. Well, it can. It can be double taxed. There's only one industry that I've ever seen that uses C Corps at lower income levels. And when I say lower, I'm talking like under $500,000. If you're under $500,000, chances are C Corp's not going to do anything for you. The C Corps become useful with the people you just referred to, the millionaires who have 7 different income streams. That's where the C Corp can become useful. Most businesses, again, are pass-throughs. You're going to hear this term a lot. I'm going to put that in finger quotes because I want you to remember that word, because this is a word that's it's very easy to remember what it means, because it literally, the definition of the word is in the word. Pass-through. What's passing through? The income or loss of the business. Who is it passing through to? Its owner or its shareholder. That's always what that word means. So anytime you hear that word, that is always what it's referring to. S Corps are pass-throughs. Partnerships are pass-throughs. Sole props are pass-throughs. C Corps are not. They are not pass-throughs. And that is both the great and the horrible thing about them. C Corps pay the corporate tax rate. That corporate tax rate that people on the news and those kids on social media like to talk about so much like they know everything. The corporate tax rate that they're referring to is what applies to C Corps. Now, if you have a C Corp and the C Corp makes money, it pays that corporate tax. But because it is not a pass-through, it now has to issue money to you as the owner. And we call that, typically it's going to be called a qualified dividend or just dividend. Well, that C Corp just paid the corporate tax. Now it's going to pay a dividend tax. Or no, sorry, you're going to pay a dividend tax on that dividend when you get that money. So that's where the actual term double taxation comes in, is you got taxed once in the corporate level and then again when you took the money out. So logically, if we don't take the money out, we don't get that double taxation. Most people whose income exceeds $1 million a year, they're not spending all that every year. I say most. Some of them do, especially the first couple of years, because, that whole novelty of being the $1 million earner. They'll find ways to spend money. They'll buy cars. They'll spend way too much on vacation, like that sort of thing. But after they kind of get that out of their system, after they're kind of like get out of rich people mode and into wealthy mode, because those two things are not the same, that's when they start thinking, okay, how can I keep more of this money and reinvest it? And that's where the C Corps can come in handy, because again, they usually don't need $1 million a year. If you're making $1 million a year, your household income need might be $300-500 at most, depending on where you're living. Most of my clients, they're taking between $300 and $500. If they're married, they're closer to $5. If they're single, it's closer to $3. But all the other taxable income can be left inside the company, and you can leverage that corporate tax rate. Now, unlike for individuals, the corporate tax does not scale. It does not go up. It does not go down. It's a flat tax. That flat tax that everyone says would be so wonderful. You can have a flat tax. It's called have a C corporation. And so long as the money remains within the company, you only get that flat tax. Now, bearing in mind that the top individual rate is 37, that's a pretty wide gap between corporate and individual at these higher income levels. I have a client who has an S Corp and a C Corp. He has a lot of businesses. Few of them, most of his money comes from a couple of them, right? He has multiple businesses, and his parent company is a C Corp, because most of the money from his different businesses is going to land in there first, and a lot of it will then be reinvested. So again, real life example, he had one business that ramped up really well. It's a strong business. They're in media, and they're in a section of media that's, shall we just say, very popular right now. And so the company is ramping up. Well, they started keeping money in the C Corp rather than taking it out personally because they didn't need it. And remember, pass-throughs pass through all the money to the owner or shareholder. So can you leave money in the company with an S Corp? Yes, you can. Are you going to pay taxes on it? Yes. Doesn't matter what you take in distribution from the S Corp. You're not taxed on your distributions. You're taxed on the income of the business. It passes through to you no matter what. You don't have a choice. With the C Corp, you have a choice. You can choose to leave that money in the company. It's not your money anymore. It's the company's money, but it's your company, so you still control it. You've ceded ownership, but you've retained control. That's going to be a theme with advanced tax strategy. You'll hear me say that a lot. So in our real-life example, this client, he left the money in his company, and then he saw a company. He's like, I want to buy that. That's a good company to buy. Well, instead of him having to pull all the money out of his own pocket, his corporation that already owns a bunch of his interests went and bought that other company for him. Now, that's an important aspect of C Corps, is you can't just hoard all your money. This is another theme with tax strategy, is the government doesn't want you hoarding money. Most tax incentives exist to stimulate economic activity. Why does the government let you go out and buy a Cybertruck and deduct it all, or deduct most of it within a year, most of the cost? Because they want to spur economic activity. They want you to go out and buy these things and run them and keep the economy going. So they don't really like it when you hoard money. But the point of the C Corp is not to hoard money indefinitely. You know, you might concentrate some capital together. So again, I see a company that I want to buy. And most people at that level, dude, they're not staying the same for a year. Okay, so first off, we need to be distinct here. Deductions come in different flavors. The two main flavors people are used to are Schedule A deductions and business deductions. We're just going to talk about business deductions here. So itemized deductions, Schedule A, your student loan interest, just forget about that for the sake of this conversation.
Travel, restaurants, what are we talking about?
Yes. So the IRS...
I do that. I do all of that, and we take all the deductions. Is there anything special?
Well, there is, because the IRS defines what you're allowed to deduct. And there's two main criteria, and they can be confusing because I'm going to say one of these words and you're going to think, oh, well, that changes everything. No. Wait till the end. Wait till the end. So you're allowed to deduct that which is ordinary and necessary. And you hear me say the word necessary and you think, oh, well, so if they can argue something isn't necessary, then can I not deduct it? An expense does not have to be indispensable to be considered necessary. That is verbatim from an IRS publication. You can look that up.
I'll trust you.
But we do. They also define in that publication. They define what is ordinary and necessary. So something that is helpful and appropriate for your trade or business, That verbiage exists for your trade or business. Something that is common and accepted in your industry is also verbiage that they use. So the industry you're in can actually affect what you're allowed to deduct and how. And there are certain industries that can get away with things more than others. But just in general, like as a general rule, you cannot deduct personal or living expenses. And this is something you'll hear a lot of the internet there's a lot of internet marketers that pretend to be tax people. There's more of them than there are actual tax people. Those people, like 4th of July is coming up here in like not even a month, right? On every 4th of July, you're going to see people on Instagram, you're going to see people sending out email bursts saying, you can deduct your 4th of July barbecue as long as you do this. First off, the amount of argument you would have to make, the amount of paperwork you would have to do to try and legitimize that is way the hell up here.